When do you take profits as a trader, and what is the best way to take profits in general? So welcome back to the Traders Improve podcast. Thank you for tuning in once again. Thank you also for all the nice emails and the nice reviews that I've been receiving. If you are listening to this on iTunes, for example, it would be so great if you could just maybe spare 1 or 2 minutes and leave a review. It really means a lot to me, and I'm reading each one of those reviews, so thank you. And today, this is a question that I got from a listener, and thank you for sending in your question. And the question is, when do you take your profits? And this is a very important question, obviously, and I believe, and I keep repeating myself, that I believe that exiting a trade is more important than entries. Most traders make the mistake that they spend the majority of their time trying to improve their way of entering trades, and then they forget everything else. But let's think about it for a moment. The way you exit your trade is much more important, obviously, because the exit of your trade determines the final outcome. The exit of your trade determines if it is a winner, if it is, or if you cut the winner too early, if you let the winner not run in long enough. The exit will determine if it's a loss, if it's a big loss, an unnecessary big loss, or if it is as planned. And so we need to spend more time on looking at exits, which I will do over the next few episodes, I think. And in this episode, I want to talk about profit taking. And there are 3, maybe 4 different ways how you can exit a trade or take profits. So the first one is R-based. So what this means is that you set your stop loss, and usually you will set your stop loss at a logical level where it makes sense. Support and resistance often is the case, or supply and demand, just highs and lows, maybe moving average. And then you just decide for yourself. You want to trade a reward to risk ratio of 1-to-1, 2-to-1, 3-to-1, 4-to-1, and that's where you place your take profit at. And this is the approach that I've chosen for myself. I moved towards this approach 2 or 3 years ago after tracking in my trading journal different take profit strategies, and I found that this for me is the best approach. It is also the least subjective way, because you're just placing your stop loss where it makes sense, and then you don't really care where the stop is. It's just a matter of distance, 1, 2, or 3 times your risk. So, or you can even go higher, obviously, to 4 or 5. It is also the easiest to implement, the easiest to test, because you can clearly see. If you always have, for example, a 3-to-1 reward to risk ratio, you can easily also see, okay, how would a 4-to-1 have performed? How would a 2-to-1 have performed? And this is very easy to test. It's also the approach with the least amount of emotional influence, because when we come to the next approach, you will see that you have to use a lot of objectivity, subjectivity. But if you just choose 1, 2, 3, 4, 5, whatever reward to risk ratio, and that's how you place your target, emotions are not that big of a deal, because it's a very mechanical approach. So I really like this one. The second take profit approach is chart based, where you use for both your stop loss and your take profit. Most traders use support and resistance, they use supply and demand, they use previous highs and lows, or Fibonacci levels, or also round numbers. However, in my opinion, this is very subjective, because there are often a lot of choices when you enter a trade, and then you look at what is in the way of the price, and you see 2 or 3 support and resistance, there's a moving average, a fib, there's a high and a low, there's a turning point. Then it is very subjective, which level are you going to use? You're using the first one, are you using the second one, the third one? How do you do that? And then it is very subjective. And also what happens is that your reward to risk ratio will vary a lot. Sometimes it will be 1-to-1, maybe 2-to-1, 3-to-1 sometimes on 1.5. and then your results are all over the place. And what I have found, that this also means that you are going to introduce a lot of volatility in your trading, because, well, your results, they often they change all the time, and then you have a lot of fluctuations. It is more emotionally taxing. So this is of course also a valid approach, but I think there are a lot of pitfalls. The third approach when it comes to take profit taking is you don't have a take profit at all, and you're just trailing your stop loss behind. The problems I see with this is that you don't have a reward to risk ratio to begin with. You don't know what to expect. It is very, very subjective. The volatility in the market can be very dangerous, because you need to be aware of how you trade your stop loss. Do you use an aggressive one where you pull the stop loss very tightly? Do you use a more passive stop loss approach where you give your trade more room to breathe? How do you change the approach from passive to aggressive? So the trade is very vulnerable in my opinion. And also, well, obviously if you don't have a fixed reward to risk ratio, and if it's always all over the place, then you also don't know what to expect, and uncertainty is a very, very big issue, especially for new traders. If you don't know what to expect, and if there's a lot of uncertainty, it can lead to fear and it can lead to doubt, which then makes trading much, much harder than it should be. Also, you can see this is not one of my favorite take profit approaches. And the fourth approach, which many traders unfortunately have, is that you don't have an approach at all. You're all over the place. Sometimes you use a take profit, sometimes you use a very wide take profit, sometimes you scale in, sometimes you scale out, sometimes you use a trailing stop loss, sometimes you use just a fixed dollar amount. And this is very dangerous, obviously. This is not good at all, because you have a lot of uncertainty in your trading, and you also lack consistency. And without consistency, you will be an emotional wreck. You will be all over the place. Your decisions are all over the place. You don't really know what to follow. And this is making you a very impulsive and emotional trader. And at least you need to decide on a few rules for your take profit to avoid such an emotional trading approach. And the more rules you have, the more consistency you will have in your trading usually, and the less emotional you will be, the less uncertainty you will have, and oftentimes it will mean that you make better trading decisions. And those are the 4 approaches to take profit taking. So let me repeat it just quickly. The first one is you have a fixed reward to risk ratio, be it 1-to-1, 2-to-1, 3-to-1, 4-to-1. The second one is that you use a chart-based take profit, which means you're using support and resistance, supply and demand, Fibonacci's. The third one is that you don't have a take profit at all, you trail your stop loss. The fourth one is that you have no approach whatsoever, and every time you take profit, it is completely random and based on different, well, I cannot even call it rules, but principles. And I hope this helps you a little bit to question where you are with your trading, and hopefully you can establish a more consistent take profit approach.